Here we go again. Back in March, interest rates went up a quarter point. Then in May, they jumped a half point. Last month, we saw rates rise 3/4. And today, the Federal Reserve raised interest rates again. We took a closer look at what this means for the economy.
It's going to cost more to get a mortgage. It's going to cost more to get an auto loan. It means that if you owe money on your credit card, you're going to have to start paying more on that because of the higher interest rate.
None of that sounds very good.
Well, it's not great, but it's necessary.
Necessary, the Fed says, to counter skyrocketing inflation, up 9.1% in June, but comes as the country flirts with recession. And according to AAA, 64% of adults have already changed their driving habits or lifestyle since March, combining errands and cutting back on dining out because of high prices at the pump, which, while falling again, a gallon of gas is still up nearly $1.20 in the last year. Food prices are also surging. Ground beef up 53 cents per pound. A gallon of milk, 59 cents.
When the electric bill goes up, when the cost of cash register tape goes up a little bit, everything goes up a little bit. We have to watch it very carefully, or we would be like out of business.
At Pinion Meats in Beloit, Wisconsin, owner Jason Turner is seeing his costs rise on seemingly everything.
I see people that are working and having to buy all this gas just to get back and forth to work. So we hate to raise the prices, but sometimes we have to.
Alrighty, ma'am, it's going to be $89.90.
Katria Ward says her grocery bill has jumped $150. She came here because she found a deal.
I went to another store. One ribeye there is $15. I come here, I get them a lot cheaper.
So you are comparison shopping?
Yeah.
The Biden administration points to unemployment levels at 50-plus year lows as a sign of a healthy economy. But GDP numbers out this week are expected to show a second consecutive quarter of negative growth, and that is often a key indicator of a recession. Chris Van Cleve, CBS News, Beloit, Wisconsin.
The Fed's benchmark interest rate now sits at about 2.5%. That's the highest it's been since 2018. You'll likely notice the Fed has made a habit of raising interest rates lately. The Federal Reserve says it's committed to getting inflation under control. Chairman Jerome Powell says the agency will keep raising rates until there's some meaningful relief, and that's alarmed some economists.
It's difficult to raise rates high enough, fast enough to slow growth, to quell inflation, but not too high, not too fast to undermine economic growth and put us into a recession.
Powell acknowledged the risk. He says out-of-control inflation poses a bigger risk to the economy long term. The White House says getting inflation under control has to be the top economic agenda item.
It's our view that inflation is the top economic priority that we need to be focused on as a country.
Right now, the average household spends about $500 more each month for the same goods and services. There is a bright side tonight. It appears inflation has started to slow. Gas prices, for example, have fallen considerably. The supply chain has started to recover. Several indices say prices to ship things peaked last fall and have gone down ever since. Experts say that means you should notice a drop soon in prices because businesses can afford to buy more goods at a cheaper rate. We're not in the clear, which is why the rates keep going up.
It can really lag. So the impact of those rate increases takes a while to trickle through the economy.
Prices have dipped slightly, but experts say we likely won't see meaningful inflation relief until the fall. High interest rates might have you spooked. They actually might have a positive impact on your wallet if you know what to do. WFMY News 2's Ben Briscoe dug into 4 smart money moves to take advantage of the rate increase.
The first place you're going to see your interest rates rise is your credit card. Call now and ask for a lower interest rate.
The credit card company's not going to call you and offer you a lower rate.
About 3/4 of the time, if you ask for a rate, you can get it from your credit card company.
Number 2, consider transferring your balance to a credit card with a 0% introductory rate. But pay off the balance by the time the special rate ends.
Be careful with some of the introductory rates because as those go away, you can actually, if you don't pay off that balance, you may get hit with that higher interest rate.
3, improve your credit score. The higher your credit score, the more likely you'll qualify for a lower interest rate on loans. Credit scores can take time to improve, so start now. Go to annualcreditreport.com to get a free copy of your report. Make sure there's no mistakes.
People do make mistakes. Companies make mistakes. And so you may see something on there that wasn't your fault, and you can dispute that.
Higher interest rates can also be a benefit. Saved money will earn more money without you doing any extra work. So number 4, shop around for a high interest savings account. Look online for the best rates.
As long as they're FDIC insured, online savings is fine.
And that's how you keep an interest rate hike from emptying your wallet.
The bottom line here, the economy's hanging in the balance. The Federal Reserve has had to balance keeping the economy growing while giving everyone the price relief they want and need. It's still too soon to know whether it worked. Count on us to keep you updated as this plays out.